Hello viewers, welcome to my channel. I'm Hasham. So now I'm going to start the second head of income, that is income from house property. Last so many videos we require for completing the head income from salary. It's the lengthiest head of income where we have so many provisions. Students are giving the comment that how we can be able to remember all the provisions. Remember, this income tax subject is little bit difficult compared to other subjects like accounting, etc. Here the student require more and more effort, more patience. Then only he can be able to remember the points. So there is no way out. First you must learn the provisions of Income Tax Act. Then only you can be able to solve the problem. So the only alternative is you have to watch the video again and again. Then only all the points you can be able to remember. Now second head of income from house property, does not have so many provisions. Easily, comparatively it is easier. So give more concentration on the theoretical part. That is the foundation for learning the subject. So when a person is having some property which is let out, whatever the rent received from that property by the owner of the property, that will be taxable under the head income from house property. And whatever provisions I'm explaining now, these are the provisions given by Income Tax Act. And all the problems are based on this theory. So watch the video till the end, don't skip in between. I'm explaining each and every point. A person can receive income from two forms from property. Suppose if you are the owner of the house property, you can have two incomes from the house property. The first income is the sale proceed. You might get some income on the sale of the house. Example, if a person has purchased the house for 50 lakh and later on he sold the house for 60 lakh, then 10 lakh rupees profit he got. That is also one of the income. Apart from that, a person may let out the property on rent. So every month he is getting the rent. That is also in the income. So in the two forms, we will get the income from house property. The first form, sale proceed. When the house is sold and we get an income, that is taxable under the head income from capital gain. Separate head is there. So when the house is sold and income derived, that is income from capital gain. When rent is received, when the house is let out and every month rent is received, that is taxable under the head income from house property. Now use of the house by the owner. There are three different ways in which the house can be used by the owner. The first way is let out of the house. One of the method of using the house is let out and every month rent is received. And that is income taxable under the income from house property, and expenditure incurred on that house will be allowed as deduction. Example, I am the owner. I have let out my house property for monthly rent of 10,000. So for 1 year I am getting 1,20,000 rent, out of which I have paid some municipal taxes, I have paid some repairing charges, I have paid some, different insurance charges. All these are the expenditure I have incurred on the house. So Income Tax Act says whatever rent you get, from that rent deduct the expenses and the net income will be taxable when the house is let out. Secondly, for running own business or profession, sometimes the owner of the building will use the building for running his own business or own profession. Then the income from such house will not be computed. And the expenditure incurred on that house will be treated as a business expenditure or professional expenditure. Next one is use for owner's residential purpose. The third form of using the residential property is using the residence for own purpose. Example, I am owning the house, I am using the house for my own residential purpose. In that case, the annual value will be nil. Some cases deduction will be allowed. Later in the coming videos I'll explain. Now if the following three conditions are satisfied, then only income will be taxable under the head income from house property. Three conditions are there. The first condition is the property should consist of any building or land connected to the building. Land should not be separate. So income from house property will be there only if there is a construction, if there is a building or land which is connected to the building, then only it will be income from house property. Secondly, the assessee should be the owner of the house property. Second condition, the property should be owned by the assessee. Then only it will be taxable income from house property. Any income derived from the property, the person should derive some income. If these three conditions are satisfied, then only income will be treated as income from house property. Deemed ownership. Actually, the meaning of the term deemed is just like, not real, but just like ownership. So, if a person is legally not the owner, but no owner of a building, but enjoys all the rights on the property, sometimes legally a person is not the owner. Legally, he is not the owner, but still he is enjoying all the rights of the property. Then he will be treated as deemed owner. Example, I am not the legal owner. The property is not in my name, but I am enjoying all the rights on the property. Income Tax Act will treat me as a deemed owner, not the real owner, but just like the owner, I am liable to pay the tax. Now, namely, letting out or transferring the property for no consideration at all. Sometimes a property is transferred without any consideration. A property is let out without any rent. Sometimes it may happen without any rent, rent free. I have given the property to to one of the person. Then what will happen? Income Tax Act will treat you as a deemed owner. You are not the real owner, but income tax will treat to the member. Example, or the property to members of the family, etc. Sometimes the property is transferred to the members of the family without any consideration. Without any consideration, one person has transferred the property in the name of another person in the same family. Without any consideration. The Income Tax Act will say the transferor will be treated as a deemed owner. Now, the following persons, though not owners of the property in the legal sense, are liable to pay tax as deemed owners. Examples. Some 4 examples I am giving you where a person is not the real owner, but Income Tax Act will treat that person as a deemed owner and he is liable to pay the tax. The first case, person transferring the property to spouse. Spouse means wife or husband. From husband's point of view, wife is the spouse. From wife's point of view, husband is the spouse. So one person is transferring the property to spouse without any consideration. And when both are living together, then the transferor will be treated as a deemed owner. For example, Mr. X transferred his own property in his own name in the name of wife. In the name of wife, without any consideration, just on the basis of love and affection. Mr. X transferred the property in the name of Mrs. X, wife. And both are living together without any consideration. Then actually the legal owner is the wife. But Income Tax Act will treat Mr. X as the deemed owner. Because without consideration, you have transferred to the property in your wife name. And both are living together, in that case, deemed owner. Next one, person transferring property in the name of minor child, except married minor daughter. Minor child. Just like in the case of spouse, a person may transfer the property in the name of a minor child. Then also the transferor is liable to pay the tax. Example, Mr. X transferred the property in the name of a minor son or minor daughter, except a married minor daughter. Married minor daughter is there, the provisions are different. But not married minor child, then transferor will be treated as a deemed owner. Then karta in the Hindu undivided family. Hindu undivided family already I have discussed in the first, second chapter. It's a person. From income tax point of view, HUF is also one of the person. The head of the family is karta. Karta is not the owner of the property. HUF property is the property of HUF. But karta is the representative. He is the head of the family. He is liable to pay tax. Income Tax Act will treat the karta as a deemed owner. You are not the real owner. Real owner is the HUF, but karta will be treated as a deemed owner. Next, member of a housing cooperative society. If a housing cooperative society has allotted the house to a member, the member still has not paid all the installments. all the installments the member has not paid. The ownership is in the name of the housing society. But Income Tax Act will treat the member as a deemed owner. You're not the real owner. Real owner is the society. But because you have not paid all the installments, but Income Tax Act will treat the member as a deemed owner and he is liable to pay the tax on the property. So these are the cases where we can say deemed ownership. Now, important points. While computing income from house property, you have to remember some points. These points will come while doing the problems also. If the building is let out to the employees who stays incidental to the business, sometimes what will happen? A business will give the house property or quarters to the employees for staying there. And the staff and the employees are giving the rent to the company. In that case, the rent received by the company is not income from house property, because the intention of the company is not to construct the house and give it on rent. The intention is for smoothly running the business. For smoothly running the business, the company has constructed some quarters beside the company and asked the employees to stay in the quarters because it will benefit the company. The employees should not come from far off places. The employees can stay beside the company in the quarters. In that case, whatever rent the company receives from the quarters is business income, not income from house property. Secondly, where the tenant has sublet the house, rent received by him will not be considered as income from house property. Example, I am the owner of the house. I have let out the house to my tenant and asked and gave the permission to the tenant that you can sublet it. So my tenant is paying me, suppose, 50,000 rupees rent per month. Every month 50,000 rent my tenant is giving, and I have given the permission to my tenant to sublet a part of the building. So a part of the building has sublet by my tenant. So my tenant is paying the rent to me and my tenant is getting the rent from sublet. In that case, the rent received by subletting the property is income from other sources, not income from house property. Next one, rent of the land and rent from huts or rent from tents. Rent from open land. If no construction is made, simply open land is there, that is let out. Rent received from the land is not income from house property because there is no property. That is taxable under income from other sources. Similarly, huts. Hut is a temporary structure. It is not a permanent property. So rent received from huts or rent received from tents, temporary, that is income from other sources. It is not income from house property. Next, where the ownership is in dispute, the ITO will decide. Sometimes the property is in dispute between two persons. Income Tax Act will not wait till the verdict of the court. In the Income Tax Act will decide, the ITO will decide who is the recipient of the rent right now. He will pay the tax presently. Then if the house is mortgaged, the mortgager is liable to pay the tax. So these are the points to be considered. Now, method of computation of income from house property. Now I am coming to the main point, that is how to compute the income from house property. In the previous videos, I have explained you how to compute the income from salary. The format is there: salary, allowances, perquisites, profit of salary. But now we are learning about how to compute the income from house property according to the provisions of Income Tax Act. Now, two types of houses: let out houses 2 and self-occupied 2. We have divided. Let out houses, those houses which are when Rent Control Act does not apply. In India, we have a Rent Control Act. This Rent Control Act is applicable to few areas, few metropolitan cities, large towns. Their Rent Control Act is applied, and other areas the Rent Control Act does not apply. So in this way, while doing the problem, we have to see whether a Rent Control Act is applicable or not. In this way, two types of let out houses where Rent Control Act is applicable and when Rent Control Act is not applicable. Secondly, self-occupied house. The self-occupied house can also be divided into two categories. One self-occupied house which is used for running our own business. The assessee is running his own business or profession. He is using his self-occupied house. Similarly, the assessee may use the house for his own residential purpose. In this way, two self-occupied houses. Now, basis of charge. How, on what basis income tax will be charged on income of the house? How the income of the house will be computed? Now, generally income from any source depends on the actual earnings and receipt of such income. Normal procedure is, we will see how much is the earning and how much is the receipt. On that basis, income tax is charged. Income tax access to the assessee, how much you have earned, how much you have received. On that basis, income tax will be charged in general sense. And for income tax purpose, in most of the source of income, it depends on how much he earned by the assessee. Most of the cases, in Income Tax Act also, the Income Tax Act will see how much the assessee has earned the income and how much the assessee has received the income. But in case of income from house property, the situation is completely different. Here, to the income capacity here, but in case of income from house property, it is determined according to the income earning capacity of the property. Remember the wording here, income earning capacity of the property, but not on the basis of actual rent receipt. Income tax act says the income from house property will be charged according to the earning capacity of the property, not on actual rent receipt. Example, suppose if you are having a flat at a posh area where the monthly rent of the property is 40,000 per month. 40,000 per month is the earning capacity. Other areas, surrounding flats, the earning of that property is 40,000 per month. But you have let out the house to your friend for only rupees 5,000 per month. Actual rental capacity is 40,000, but you are charging only 5,000 from your friend. In that case, Income Tax Act will not consider your 5,000. Income Tax Act says what is the earning capacity of that flat. It is 40,000. So income tax will be charged according to 40,000 rent, not according to 5,000 what you have received, right? Now, the income earning capacity of the property is known as notional income, and under the Income Tax Act it is termed as annual value. Now remember, normally it is called notional income. Notional income means the earning capacity of the property. But from income tax point of view, instead of calling it as notional income, the Income Tax Act has called as annual value. In examination, you may be asked a theory question, what do you mean by annual value? So annual value is the notional value of the property. Notional value of rent of the property. Now annual value. Income from house property is computed based on the annual value. Remember, the income tax on house property will be charged on the basis of annual value. The first point in computing the income from house property is the annual value. Right? According to section 23(1)(a), the annual value of any property shall be the sum for which the property might reasonably be expected to be let out from year to year. This is the definition given by Income Tax Act regarding annual value. So what is annual value? It is a sum for which the property might reasonably be expected to be let out. What is the earning capacity? What is the sum at which the property will be reasonably be let out? Reasonably be let out from year to year. In determining the annual value, the following four factors has to be considered. While computing the annual value, Income Tax Act says four factors has to be considered in order to find out what is the sum at which it might be let out from year to year. The four factors to be considered are municipal rental value, MRV, actual rental value, ARV, fair rental value FRV, and standard rental value SRV. So MRV, ARV, FRV, SRV. By considering these 4 items, we calculate the annual value. The first item to be calculated for computing income from house property is annual value. In the next video, I'll explain you about this municipal rent, MRV, FRV, ARV and SRV, inshallah. So if you're satisfied, give a like to the video, share my channel among your friends, among your groups, so that more students can watch the video and enhance the knowledge, and give your comments on this video. Subscribe my channel if you have not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we'll continue the next topic in the next video.